Hi everyone, welcome back to the channel. In today's video, we are going to talk about the unseen costs of your portfolio, the fees and the taxes that devour your portfolio over time. Imagine a glass filled with water, sitting quietly on a table. You don't see any cracks, but slowly, drop by drop, the water level begins to fall. You don't notice it at first, but over time, the glass ends up half empty. That is exactly how fees and taxes work inside a portfolio. You don't see them, you rarely feel them, but over decades, they quietly erode a significant portion of your wealth. Most investors focus on returns. Very few pay attention to what silently subtracts from those returns. Today's video is about understanding those invisible costs and how to manage them intelligently. Fees and taxes are what I call silent wealth destroyers. They don't create market crashes. They don't cause panic. They simply work quietly in the background, year after year. What makes them dangerous is that they compound negatively. Just like returns compound in your favor, costs compound against you. If your portfolio grows at 8% returns, but you lose 2% annually in fees and taxes, your real compounding is closer to 6%. Over 30 years, that difference can mean hundreds of thousands or even millions of dollars. This becomes even more important as your portfolio grows. At a small portfolio size, the damage is limited. At a large portfolio size, costs begin to dominate your long-term outcomes. So let's deconstruct the fee monster first. Let's look more closely at investment fees, because this is where many investors unknowingly lose the most. The most common fee is the expense ratio. This is the annual cost charged by a mutual fund or ETF to manage your money. Index funds usually have very low expense ratios, often 0.2% to 0.1%. Most S&P 500 index ETFs have a low expense ratio around 0.02% to 0.03%. The reason is simple. They are not trying to outperform the market. They are simply tracking an index like the S&P 500. That requires minimal research, minimal trading, and minimal management. Actively managed funds, on the other hand, often charge 0.75% to 2% per year. Why are they more expensive? Because they have larger teams of analysts, they conduct continuous research, they trade more frequently, they market more aggressively, they distribute through brokers and advisors who receive commissions. Many investors don't realize that part of the expense ratio in active funds often goes towards distribution costs, including broker commissions, advisor incentives, marketing expenses, sales networks. So, you are not only paying for investment management, you're also paying for the system that sold the product to you. And importantly, higher fees do not reliably translate into higher performance. Studies after studies show that most active funds underperform the low-cost index funds over longer periods of time, especially after fees are deducted. Now let's put this into numbers. Assume you invest $1 million for 30 years at 7% annual returns. With no fees, it grows to about $7.6 million. With a 0.5% fee, the ending value becomes $6.6 million. With a 1% fee, it drops to around $5.7 million. With a 2% fee, it falls closer to $4.3 million. That difference is not theoretical. That is real money lost to friction. This is why low-cost investing is not about optimization. It is about protecting decades of compounding. So now let's get into the tax dimension. Taxes are more complicated than fees because they depend on where you live, what you invest in, and how long you hold. In the US, investors typically face taxes on dividends, taxes on interest income, short-term capital gains, where assets are sold within 1 year, long-term capital gains, where assets sold after 1 year. Tax vary by income level and filing status. This already makes tax planning an important part of investing. But things become more complex when you invest across borders. For example, you are a tax resident of India and you own US assets. Your US income may be taxed in the US and also considered part of your global income in India. Even under a double taxation treaty, your effective strategy changes based on which country has higher taxes for that asset class, which country offers lower exemption and deductions, which increases your taxable income in the respective countries. How dividends, capital gains, and interest are treated in each country. It becomes more complicated with tax advantage accounts. US accounts such as Roth IRAs, HSAs, 529 students accounts, plans are tax advantaged under US law. But countries like India do not recognize these as tax advantaged. So income or gains inside these accounts may still become taxable in India, even if they are not taxed in the US. This is why global investing requires tax awareness, not just market knowledge. So now let's talk about the trade-offs, fees, taxes, and risks. Once your portfolio becomes large, your net outcome depends less on picking the perfect asset and more on how you manage these three. There is always a trade-off. If you invest in a single stock that pays no dividends, you avoid annual dividend taxes and funds expense ratios, but you accept much higher concentration risk. If you invest in crypto, for example, there are no dividends, but the expense ratios of crypto products are often higher and volatility is significantly higher if you invest in low-cost index funds. But the expense ratios on crypto products are often higher and volatility is significantly higher. If you invest in low-cost index funds, you pay small expense ratios, but your risk is diversified across hundreds of companies. Index funds solve another long-term structural problem. The largest companies today may not be the largest companies 30 years from now. An index fund automatically adjusts. It removes declining companies and adds rising ones based on market cap of those companies. You do not have to guess the future. This is also why buy and hold investing tends to be tax efficient. When you trade frequently, every sale becomes a taxable event. If you hold for decades, taxes on capital gains are deferred, allowing compounding to work uninterrupted. If you hold individual stocks and later need to sell because the business weakens, that sale triggers taxes. If you incur losses, you can use tax loss harvesting to offset gains, but that still requires active management and discipline. Long-term indexing minimizes both behavioral mistakes as well as unnecessary tax friction. So now let's talk about how to reclaim your returns. The key takeaway is simple. Returns matter, but net returns matter more. As your portfolio grows, your financial outcome increasingly depends on how low are your costs, how tax efficient your structure is, how disciplined your behavior remains. A portfolio of $50,000 can survive inefficiencies. A portfolio of $2 million or $5 million cannot. If there is one practical action to take after this video, it is this: review your portfolio carefully. Look at expense ratios. Understand your tax exposure. Avoid unnecessary turnover. Favor simplicity over complexity. We cannot control markets, but we can control costs. And over decades, that control can mean financial independence arriving earlier, with less stress and with more certainty. Thank you for watching.